Thank you for joining us at XM.com. This is the Daily Market Comment by Mario Sachikiriakos. I'm Christina Marujos. The Federal Reserve officially kicked off its tightening cycle yesterday, raising interest rates by 1/4 point. Although the rate hike itself was fully baked into money markets, the central bank still delivered a hawkish twist by signaling another 6 rate increases for this year through its dot plot projections. That was exactly in line with market pricing heading into the event, but exceeded even the wildest forecasts among economists, who expected a slower approach. Chairman Powell spent most of his press conference emphasizing how strong the U.S. economy is, arguing that it can absorb tighter monetary policy without tipping into recession. Overall, the takeaway was that the Fed is serious about combating inflation. Even though the Fed made it crystal clear that it wants to tighten financial conditions, market participants did not play along. Shares on Wall Street closed the session with stunning gains, while the U.S. dollar fell almost across the board. There are a couple of factors that might explain the strange reaction. For example, Powell didn't seem very comfortable with raising rates in 50 basis point increments, and there weren't any new revelations around the balance sheet reduction process. However, this may have been a classic case of sell the rumor, buy the fact for equity markets. Many big players were likely flush with protective hedges, which they unloaded once the event passed and volatility cooled, sparking a relief rally. In the broader market, there's been a feel-good atmosphere for most of the week as traders scramble to price in the prospect of a peace accord in Ukraine. The latest reports suggest negotiators have made significant progress on a ceasefire, with Moscow willing to withdraw if Kyiv pledges to remain neutral and accepts caps on its military forces. Optimism that these talks will bear fruit has seen the euro stage a meaningful recovery, mostly to the detriment of the Japanese yen. The British pound has also been a beneficiary of the peace bets, outperforming even the war-stricken euro in recent sessions. The Bank of England will conclude its own meeting today. A 1/4 point rate increase is fully priced in, and markets imply a 1 in 3 chance for a half-point move. Hence, the initial reaction in sterling will depend on the size of the hike. Finally, the Bank of Japan will also meet early on Friday, but it is unlikely to signal an exit from decades of easy money policies. The yen remains at the mercy of risk appetite and the actions of foreign central banks. Thank you for watching today's Daily Market Comment here at XM.com.